Last week we were discussing some ratios, and I remember I stopped here. The next ratio, we're still in the operating ratio, but the next ratio which I want to discuss with you is called inventory turnover ratio. Turnover means that, first of all, we need to understand what exactly is meant by inventory. Inventory includes the raw material plus semi-processed goods, which are half-baked, plus the finished products not ready yet. Finished products, but not sold yet. They're ready. They're in your warehouse. If some customer comes and say, can I buy some chairs? Not these ones, but I saw that you had chair yesterday. And then you call, I think we have in the warehouse, bring them. They're ready. We just need some basic polishing, just repackaging and everything. The question is how fast you change your inventory. Faster the inventory is transformed into a product and sold, more efficient the company is. Ratio formula, cost of goods sold divided by total inventory. Okay, if this ratio is higher, it means that you are transforming, you are converting the inventory into the final thing faster. It means that the shelf value, the shelf duration of the inputs waiting to be processed is less. And that's what we want. We don't want to buy inputs, stay in our warehouse for months and months and never been used. We want them to be channelized faster. Because when you use the inputs, raw material, it shows that your factory is running faster and you're transforming the products quicker. So it's a sign of activity. This is why these operating ratios are sometimes called as activity ratio, that how active you are. Faster the transformation of inventory to the final output, quicker, faster the company is operating. Okay. This ratio is very interesting. Now, it's very important for you to understand that how many days you must have the inputs. So for example, you have calculated the inventory ratio as here mentioned. So this inventory ratio you calculate by dividing the cost of goods sold with total inventory, right? And you know the cost of goods sold? Cost of goods sold are your operating expenses. Cost of goods sold are your operating expenses. Should I show you where they are? I think I need to open the, so for instance, you can see here. These are total revenues, but if you see from here to here onwards, these are companies' operating expenses. So to calculate inventory ratio, what you need to do is, you need to have the cost of goods sold, which means from here to here. Well, you don't have to add it. If you have this figure and you minus this profit, that will leave the total cost of goods sold. Are you with me? Look, this is this, the total revenue minus total cost is, the profit is this. But for example, if I have 244, 582, and here is some cost of goods sold. I don't know how much. Well, I can. If I add each of them from purchase to distribution and admin expenses, I don't have to. When I minus this, what I get is 9474. So how can I get cost of goods sold? Simply, if I subtract 9474 from this figure, what I would be left with is a cost of goods sold. Isn't it? It's like saying that what should be subtracted from 5, that the answer is 2. Well, subtract 2 from 5, you'll find X, 3. You get my point? Okay. So once you have this cost of goods sold, you can divide by inventory. And where are inventories, by the way? Anybody tell me, where do you find inventory data? Inventory is an asset, is a property of the company. Where is your guess? Inventory. Will it be in the current assets or in the non-current assets? The non-current assets are which are you can use for a year or beyond, and the current asset is the one which you can't use beyond a year, basically. Most likely in the current, because inventory normally never stay beyond a year. A company is really inefficient if inventory is there beyond 1 year. For this, I need to look at the balance sheet. And you can see here that there are inventories here. So after I have the cost of goods sold, the way I calculate here, and if I divide by the inventory, that will give me the inventory ratio. Sometimes you can ask yourself, how many days? Isn't it a matter of interest that you should start thinking for how many days you should keep, for example, today is 20th of February. For how many days I should have the raw material, etc., in my warehouse so that I don't have any problem? Do you buy raw material every day and then start factory every day? Don't you want to keep a safe limit that how many days input should always be there in your warehouse? Are you not interested in that? Well, you should be. That's a part of the planning. Because if you every day you open your factory and you find, oh yes, how many orders we got? All right, then you order your supplier. Can you bring the inputs? That would be awful planning. You must have certain days stock lying in your warehouse all the time. You can know it. How? Here. If you have your inventory ratio 5.46, which I found for in the previous example here, let's say, and if I divide by 365 days, it comes out to be 66.81 days, approximately 67 days. Basically, it shows that at any day, there should be stock equal to 67 days in your warehouse. So at any day, you must have 67 days stock in your factory. So today on 20th of February, 20th of March, 20th of April, let's say I should have stock in my warehouse till 27th of April so that I'm safe. So that I don't have to call my supplier every day. If I call supplier every day, first of all, when you call every day, you buy in small quantity, all right, he would charge more price from you. But when you buy the bulk quantity, there is a economies of scale. Plus, you are rest assured that you don't have to suffer from. Imagine your customer calls you, can you send me new output? And there's no raw material in the factory because you don't plan. This could be bad planning, or rather no planning. So according to this example, there should be 67 days stock lying in the company at any point of time. But when I check for BP based on the historic data, I find out that the inventory days in hand are 22. All right, it means that BP must have 22 days data. And you can also see historically, okay? I would say shorter the period, better it is. Why? Because if you have to forecast and keep the stock with you all the time, this would put extra additional rental cost on you. The raw material can spill, can soil, can be damaged. Plus, you need to have more space for keeping it. It can add your rental overheads, and you have to employ more people who look after these stocks and stuff. Okay. Yeah. So you can see that this used to be very bad. almost 37 days. But now it's more or less okay. Not so bad, but not so good either. So this tells you that BP must maintain. My last figure was 2015. So BP must have 22 days inventory at any point of time. So today on 20th of Feb, BP must have inventory up to 10th of March, approximately. And then every day it's like a rolling period, keeps going up. The next ratio is accounts receivable turnover. Before you know accounts receivable, you must know who are accounts receivable. Accounts receivable are your debtors. Imagine I sold something, I sold on credit. The person I sent invoice, he doesn't pay. He only put a signature stamp, which means that he accepts that he owes me money. And the general deal is that he would pay me after 3 months. The sale is made now, but the customer would pay me in 3 months' time. For 3 months' time, he would remain my accounts receivable. Remember, we did the entries, debit, credit, a couple of times, that if you sell something on cash or if you sell something on credit, how transaction would look like, right? So here, they are the accounts receivable. And the ratio is net sales divided by net accounts receivable. A higher ratio means that your customer don't make you wait for a very long time. If this ratio is 9.42, it means that during a year, there are 9.5 times occasions when people pay you. So even though they buy things from you, they pay you. If this ratio is small, it means that customers really test your patience. And when you divide this ratio by 365, it comes out to be almost 39 days, which means that on an average, if somebody buys goods from you on credit, would pay you back in 39 days. You get my point? So your waiting period is 39 days. See what, if this ratio is bigger, then it comes in the denominator and the final number would be small. You get my point? So if this ratio was 11, then this number would be smaller than 338. So primarily, it shows your waiting period, at how many days your debtors, your customers who buy goods on credit from you, for how many days make you wait. And when we test the real life situation, the BP, we find out that on an average, the BP's customer, this is the real situation, on an average, BP's customer make BP wait for 36 days before they pay. I would say, considering that it's an oil company, considering that it's a B2B company, this 36 days is not a very bad period. But if this 36 days is for a retail store, Walmart, Morrison's, Sainsbury, Lidl, Prisma, it's a worrisome situation. So these ratios are higher or low, the numbers are low or less big. It depends upon the business practices. Those businesses where B2B part is larger, these numbers would be larger. But where there is a B2C situation, we expect the numbers to be smaller. Okay. The next ratio is accounts payable. How much you make your supplier wait? Just opposite. Accounts payable is the money which you owe to your supplier. If I'm a company and my customer owe me are my receivables, but I also bought raw material from my supplier. The money which I owe to my supplier is my accounts payable. Payable. Accounts receivable and payable can be both current and non-current assets and liabilities. If it is less than a year, then it's a current. If it is a year or more, it's a non-current. You know the definition of long and short period in finance is 364 days cutoff point. Accounts payable, cost of goods sold divided by accounts payable. If this ratio is smaller, then you will make your supplier wait for you more days. But if this ratio is large, not 11, but 15, 16, then you will make your suppliers wait for less time. What do you want? Tell me frankly. Do you want to receive money faster from your customer and delay your supplier, or you want to give more time to your customers and you want to expedite payment to your supplier? What do you want basically? To pay the supplier quickly, but then imagine you are in a business where the customer pay you late. So your customer is paying you after 3 months, but you pay your supplier after 1 month. Will it be?
It's all in the budget, like you already paid.
Yeah. So basically, you don't say it, but you think it loud. That hey, you know what? Given the choice, my accounts receivable days should be as less as possible. So people pay me faster. I don't have to wait much. But given the choice, I want that I should delay my payments to my supplier as long as possible. Reason? You remain solvent. There's no immediate cash payment pressure on you. Isn't what you want? Well, you should want it. If you don't want it, then you should. Come on, I'm your teacher. If I say, you must accept me. Okay. And then comes the cash cycle, that what should be the overall cycle. And cash cycle is very simple. The number of accounts receivable days plus the number of inventory days minus accounts payable days. You want them less. Because if they're less, it means that you are converting the inputs to output faster, efficient. You want them less. You want them less. Inventory days less. You want accounts receivable days less. They should pay you faster, but you want that you should pay your supplier as delayed as possible. And when you make the final, it comes out to be 72.6 days. Here, it means 73 days. What does this 73 day mean? This 73 days mean that at any point of time in the company, there should be bank balance enough so that you can finance your 73 days operations. So if today in your bank account, your bank balance is only for the next 10 days, you are heading for a liquidity crisis. Liquidity means your immediate paying capacity. These number of days, would you like to have a larger cash cycle or a smaller cash cycle? You should have a smaller cash cycle, because see what it means, that for 73 days, your money is stuck in the bank. You can't use it. Well, you can use it, but you will not dare to use it because it can invite a problem upon you. Your bank account is not blocked, but you block it by yourself. It means that at any point of time, if you want to be a safe company, there should be money enough in the bank account for the next 73 days. 73 days operations can be financed. Given the choice, you want it smaller. so that your money is not stuck and you take less loans. Because, for example, 73 days operations are a lot of big number of days. So you might have to take credit from the bank, and the bank charges interest. It's not free. So given the choice, you would like to have as short cash cycle as possible, and that's only possible if your accounts receivable days are less, means your customer pay you fast. Plus, you convert your inputs to output fast, and you delay paying to your suppliers. If all these virtues are met, your cash cycle becomes smaller. Hence, you don't have to worry too much for the future. Worrying 30 days is less worrisome than worrying 73 days. You get my point? So therefore, a company would like to have a cash cycle as shorter as possible. Let's check for BP. There we go. Not bad. BP's cash cycle used to be 24 days. So they have to keep money in the bank account enough to keep 24 days. But now it's almost 1/3. It's efficiency, isn't it? So they don't have to plan too much. And do you know, can you relate what this 2007 means? Anybody know some historic event? This was a time when Gulf of Mexico happened, when BP spilled oil in Gulf of Mexico, and the company was nearly on the verge of bankruptcy. Bad years. Many years the company stock price went down. In fact, not only BP's stock price went down, almost all the oil sector crashed because people started thinking that if BP is doing, I'm sure others are also doing, just because they're not caught, just because they have not spilled oil, or maybe they have, but nobody noticed. So basically, this gives us another lesson that sometimes your competitor's loss is your gain, but sometimes your competitor's loss is your loss also, because you are also labeled with the same, painted with the same brush. And this happens in case of Enron. When Enron failed, all the energy companies' stock price went down. And when this BP fiasco happened, all the oil prices, all the oil companies, they suffered because people had a very bad image about the oil companies. That was a point when people start thinking these oil companies are very bad because they are really toying our ecosystem, our ecology. And the stock prices went down significantly. All the companies, even the competitors who don't want to see BP existing, but even they suffered. So this is the cash cycle. The next category of ratio is liquidity. Liquidity means how liquid is your company. Okay, so we have some additional ratios. You can say that you can even call cash cycle as a liquidity ratio, but this is more like a efficiency ratio. A company which is more efficient have a smaller cash cycle. Okay, but you can also link it with liquidity. But before I go full-fledged liquidity ratio, I want to ask you, the next set of ratio is called liquidity ratio, and the first ratio is called current ratio. The current ratio is current assets divided by the current liabilities. And I don't believe it, but the rule of thumb is 2:1. At any point of time, the ratio should be 2:1. But as I said, it's only a legend. It's only a bottom line. I don't care much about it. If it's an oil company and the ratio is less than 2.1, I'm not worried. But if it is a retail company, the ratio is less than 2:1, I'm worried. So basically it means that at any point of time, your current assets should be double the current liabilities. Only then you can have 2:1 ratio. Okay. And what does the current assets include? Well, you have seen many times now. These are the current assets. These are the current assets from here. Short-term loans. How can loan be an asset? Is it a mistake? Huh?
If you loan?
If you give loan, it's an asset. Yes, the companies give loan to other companies, or company give loan to your partner with in the joint venture, for example. So if you give loan, it's an asset because then you own it. So the current asset is loans, basically inventories, trade, receivables, derivatives. Don't care about this. We have a special assignment too based on derivatives. We'll come to this later. Prepayments. If you make a prepayment, I pay you wage in advance. Imagine you are my workers. Worker is a bad word. You are my executives. If I pay you salary, 2 months salary in advance, then you are my assets because you owe me because you got the money before you work. So it's your liability, but my asset. But for the short period, because the prepayment is only for 2 months. And all other things, cash and cash equivalents. What is meant by cash? Well, you know what is cash. What is meant by cash equivalents? Isn't it something called cash equivalents? Equivalents means something equal to cash. Valtteri?
Assets that you can transfer to cash rather fast.
Very fast. Yes. Yes. Very good. Valtteri is right. Those assets which are not per se cash, they're not cash per se, but you can convert them to cash very fast without any loss of value. If you have the government bill, like let's say you have bought Bank of Finland's papers, right? Of course, when you go to do shopping, you can't give at the till point those papers and buy the grocery. But if you go to the bank or a broker, you can sell it without any problem. Without any problem. Okay. It can be a little bit inconvenient to go to the bank or a broker and sell it, but it's not. You don't have to wait for years to get it converted to cash. So they are called cash equivalents. And one more thing. If I'm a business person, I run a company. You are my bills receivable, trade receivables. You get my point? You're my customers. I sold goods to you. You haven't paid me. You have the invoices. You gave me the invoices. I need money urgently. I can send those bills to the bank and get money quickly without any problem. Because they would see that these are genuine sales invoices. Shab has sold goods, customers agreed to pay. Let's give him some money, and after 30 days, when the customer pays him, he would pay to the bank, things settled. Right? So these are the current assets, and these are, the bottom ones are the current liabilities. Trade payables, derivatives, accruals. Accruals means, if you don't know, well, these are non-current. Here we go. The current trade payables, derivatives, accruals. Accruals are, have you heard this word before? Accruals. What are accruals?
You told us.
That's a good description. Imagine you're sitting in the exam and the question is define accruals, and you say, ask Shab for details because he said, and I know it that he said it. I'm very confident. Then we get, but that's a good joke. Was it a joke actually? No? I take it as a joke. Yes, accruals are the payments. Accruals are the payment which are due but not made. Let's say you work for me for the whole month of February. End of February, I should pay you. I didn't pay you. I go to the month of March. In the month of March, the wages due, the February wage due are called accruals. It shows a short-term liability. This is why you can see the accruals are only in the, well, they are in the long term also. It means that there is some expenses which have accrued, but you haven't paid beyond a year. Well, for a big company like BP, I can agree that there could be delays, right? But generally, accruals could be for the shorter period. Okay. And likewise, anyways, at any point of time, your current ratio should be 2:1. As I said before, I don't believe in this 2:1 thingy. Look at how much is BP situation. We need to go to the liquidity ratios. And where is the current ratio? It has never been close to, it has never been close to 2. The best it has been close is 1.37, but I'm not worried. I'm not worried about it because BP is a B2B company majorly. The gas stations are basically franchised rather than the BP, you know. So most of the BP's operations are B2B. For a B2B company where this is not a big problem. If I want to check the real situation of BP, is it good or bad, I would check, for the sake of argument, another oil companies. I would compare BP with the oil company and then see, is it a bad situation or not so bad situation? But anyways, the company has nearly 1. So 1 is not so good actually because it can put you in trouble. But 1.29, 1.37, not too bad. There's some good reasons of high current ratio. It shows that a build-up of inventory is good. Inventory is a current asset. Okay. The one good argument is that if you have a lot of inventory and you are making lots of advertisements, hopefully your sales will pick up. Your customer will demand more. If they demand more and you don't have inventory, this can be a very dismal situation. The customer are ready to buy from you, but you don't have raw material to process it. So this is a good reason. You must have a permanent expansion of the business, which will require higher level of inventory. The company is getting bigger and bigger and size is increasing. You need more inventory. And then there are some bad reasons also. Okay. The company is losing money, but with the increased cash, you are covering up your sins. Okay. Another reason, bad reason could be that your working capital management is poor, and this is why the cash rate, and you are taking lots of loan from the bank. Okay, your cash balance is substantial, but most of the cash is a debt. If somebody shows you his or her income statement or a bank account, for example, and the bank balance shows that you own some millions of euros, don't get impressed. Ask the person, can you show me your full bank statement? We want to check how much is debt. Because if you borrow and you show high cash, it's not a performance. It's rather a liability. Okay, so it's very important that you need to find out that is this increase in the cash, the current ratio, is it for the good reasons or the bad reasons? How to improve current ratio? Well, slow down debt repayment, acquire a long-term loan which is payable beyond a year. Selling a fixed asset, is it a good reason? If your company is having less cash or less current assets, should you start selling your assets? Because when you start selling assets, your cash bank balance will show zoom, it will be big increase. But that's not a good reason. How would you operate? If you start selling your property, assets, then you may not even exist. The next ratio is called acid test ratio or the quick ratio. The quick ratio is no different from current ratio. The only difference is that we don't consider inventories into it. The reason we don't consider inventories into it is that most of the current assets have a quality that they are convertible to cash very fast. But imagine you have lots of inventory in your factory and you need cash. What will you do? I repeat, most of the items in the current assets are easily convertible into hard cash. The bills, the notes, except for inventory. Why not? This is why in this ratio, we don't consider inventory. And that's why we say minus inventory. Any ideas? Why inventory has no such element of getting converted to cash faster?
Takes time.
It takes time because you can convert inventory to output. But what if there's no client outside? What if there's no customer? And the second reason is that, can you sell your raw material in the second-hand market? It's not easy. You might have to sell at a discount. If you are a furniture making company and you have a lot of wood or semi-processed, a chair with two legs, if you have to sell it in the open market, people would not pay you deserving cash. So the conversion power of inventory to cash is not so substantial as the other assets are. That is why some accountants say that we should not even consider inventory into the block of current assets, and that's why they minus it. Walter, you have a point?
Yeah, what's the difference between the liquidity? I mean, like, how fast are you supposed to turn an asset into cash for accountants?
Yeah, well, we want basically that the gap between the current assets and the current liabilities should be as big as possible.
No, but I mean, what's the time frame that you're supposed to be able to turn something?
No, you need to have, that depends upon the inventory turnover ratio. If the inventory turnover ratio is fast, hence the inventory days are small, then at a given point of time, you have to have less inventory. Now here, the point you raised is very important actually, Walter. Now I can see a potential clash between operating ratio and liquidity ratio. Walter had a point. If your inventory turnover ratio is fast, inputs come, they become output faster. You need to keep the raw material for lesser days. And when you maintain for the lesser days, you might not require so much inventory at a given point of time. Hence, your stock of inventory is small. And inventory is a part of your current assets. So then your current assets can squeeze. And maybe this is the limitation. That's why they want to keep inventory out of this formula. Because inventory can be confusing. Too much inventory is good for the current ratio, but not good for the operating ratio. But generally, we prefer that we should have smaller inventory at any point of time, because that saves our rental expenses, right? That saves our other admin expenses. Okay. We don't want to build up inventory for a long time, unless your company is really growing fast. In that case, yes, you need to keep inventory for more days, because now your company, it's a positive problem in that case. But in given situation, we would like to maintain lesser inventory balance, provided it doesn't hit your operations. Okay, if you have a safe limit of inventory, not so big, then I think it can save your many fixed costs. Yeah, that's what I understand from your question. The next ratio is called cash ratio. Accountants say that, hey, why are you talking about bill receivable inventory. Just talk cash. How much cash you have? Cash is the king. Why do you talk about the current assets? Because after all, you have to convert current assets to cash. Why don't you only consider cash? Cash over current liabilities. At any point of time, this ratio is good. Higher the ratio, better it is. It means that if the company has more cash, you are able to finance your expenses faster. You don't have any liquidity crisis. Okay. But once again, the one size doesn't fit all. The next category of ratio I want to discuss with you is called solvency ratio. The solvency ratio means that how solvent you are. What kind of description is this? Solvency ratio is how solvent you are. Liquidity ratio tells you basically that your current assets should be more than your current liabilities. Solvency ratio tells you that your total assets, total, not only current or non-current, total assets should be, not should be, must be more than total liabilities so that you remain a solvent company. If your company's total assets are 40 million, both current and non-current, and if your company's liabilities are 30 million, don't shout, just raise hand. What does this 10 represent? Just raise hand. If your company's total assets are 40 and total liabilities are 30, it means assets exceed liabilities by 10. What is this 10? Free assets? There is no such term. We use free cash flows, but no free assets. Yes?
You're 10 million solvent.
I want to look at the right word. Very good. Capital. Excellent. Remember, we were doing the transaction recording that assets are equal to liabilities plus capital. Remember this accounting equation? Same apply here. Total assets, total liabilities, the gap is capital. And if imagine this is 30, 40, this is minus 10. It means that the company's capital or equity, capital, just capital or just equity is minus 10. It means that shareholders' value is not only zero, but you see what? When the shareholders' value is zero, it means that all is lost, go home. But when it's negative, not only all is lost, but pay another 10 million and then go. It's like a bondage. It's like a slavery, isn't it? Not only shareholders have lost everything, what they have, but before they get rid of the company, they need to pay another 10 million. This is a diabolical situation. So therefore, at any point of time, company's total assets must exceed total liabilities so that the company's capital is positive, hence company is solvent. There are many ratios. Total assets minus total capital, total equity is a or divided by total asset. That's several ratios you can do. I will not go each one. I mean, they are small variants. But for me, this ratio is very important. Total debt to total equity ratio. Total debt to total equity ratio. This ratio is most widely applicable in accounting and finance research. All my students who do quantitative research with me in the thesis, they apply this ratio as a measure of companies' debt. And by the way, the solvency ratio is also called leverage ratio. Leverage is also the word we use. Lenders observe this ratio a lot. Okay? If you're, have a look at this. debt to equity ratio. Can you see this? It shows that BP used to have 54%. So for every $1 of shareholding or equity share, BP used to have 54 cents of debt. But over the time, debt is going down. Over the time, the company's debt is going down. Okay, debt, as I said, is very tempting. Debt has many qualities. Debt can keep the management on toes all the time. It's like a disciplinary action. It can keep you accountable all the time. But too much accountability also can dampen your motivation, and you can be forced to commit mistakes. You got the idea? If you are under surveillance all the time, you can make some mistake. All right. Debt can put pressure on you. Too much of debt can invite bankruptcy cost. One thing I want to ask you, because I told you, so I have a reason to demand an answer from you. Debt has one more advantage. And that advantage lies that advantage lies here. I can highlight that area. And if you know it, please raise hand. Don't speak out. Debt has advantage. One advantage which I didn't discuss today, but I discussed a few times more in the class. And the answer to this quiz lies here. Debt has an advantage that it is treated favorably by taxman. Here you see the finance cost. The finance cost is primarily finance cost is your interest expense, the interest. Why do you pay interest? You pay because you have debt. It means that larger the debt, larger would be expense, and larger would be escape from taxman. How? You pay the share of profit to the debt holders in the form of interest. It means that your profit is shrinking. Let's say you have 20 euros of, what do you call it, profit before tax. So profit before tax is 20. Interest is 10. Profit is 10. Tax would be, the taxman would charge you tax on this money. Whatever, 30%, 20%, 40%, depending upon country to country. Now imagine you borrow more. When you borrow more, you pay more interest. And when you pay more interest, profit will go down. Profit after tax, PAT, will go down. When it goes down, you pay less money to taxman. So it means that basically the interest expenses are subsidized by the taxman. However, the shareholders get the dividend. This is the profit after tax, final, which goes to shareholders. But see, the shareholders get the money before tax is paid. So the shareholders are treated unfavorably by the corporate tax system. So it could be possible that your profit, either there's no profit left here, or there is a very less profit left here. So nothing is left for the shareholders. It could be possible. But the interest, the debt is always preferred over. So first you pay debt expenses, the interest, then you pay to taxman, and if something is left over, residual, then it goes to shareholders. This is one reason, and this is one reason in the countries, in those countries where tax rate is very high, for example, Finland. It's a matter of question. It's a good thesis topic. Check a sample of Finnish companies and check a sample of US companies or some Anglo-Saxon country or maybe some country where the tax rate is very low. In theory, by that argument, the Finnish company should have more debt to equity ratio. And the country where tax rate is very low, they should be indifferent between the two. So in theory, the Finnish companies, because of high tax rate, they should have higher D to E ratio, debt to equity ratio. And then you take a sample of the non-Finnish companies, not Swedish company or Norwegian, but find somewhere in Singapore or in Britain or elsewhere and find out that do they also have the low or high? Does tax affect the company's financing choice? This can be a great thesis topic. Nobody has done so far. Think about it. Comparing Finnish companies with non-Finnish companies. But I would say that in theory, by logic, Finnish companies should have more debt to equity because they want, if I'm a company and I have a choice to pay to my investor or a taxman, believe me, I would like to pay to my investor. And people who give debt to the company, they're investors, by the way. Okay, so that could be a possibility. And then some other ratios. For some time, I want to have some discussion among you. Did I discuss with you that what factors contribute to a company to be better borrower? Have we discussed? No? Okay, let's have some discussion. My question to you is, these red things you can see later on, but my question to you now is that what factors can prompt you, the company, to borrow more? Or what are the qualities of a good borrower? If I'm a banker and I get the application from you, which should be the parameter which I follow before I give you the bank loan? How would I categorize you that he is a good borrower, she is a good borrower, but he is not, she is not? So basically, I'm asking you, what are the prerequisites of a good borrower? If you are a company, what kind of company characteristics you have so that you are a good borrower? You look appealing in the eyes of a banker. The banker says, please come. I will give you debt. Not that, hey, no, go away. I will not. You don't qualify to be a good borrower. Sorry, I can't give you loan. So what are the qualities of a good borrower?
Current ratio, current ratio, assets, liability.
Okay.
Capital.
So if you're a company with more capital or less capital makes you good borrower?
Okay.
Yes. If a company have good, I call capital as an internal, equity capital is an internal capital, yeah? So if a company has more equity capital, then the risk is not only, if the company have very less capital, equity, but mostly borrowing, then more debt can make company risky, yeah? But if a company has already a lot of capital, then the risk is shared between the bank and the shareholders. You're right. More equity capital, better the borrower. Yes, Igor.
Make, they have a good capital and they want to make investment money
Mm-hmm.
or
So, do you mean that if you have the good investment prospects?
like, I mean, they use it as a leverage,
Mm-hmm.
like yeah, someone has capital, but they don't have enough money to grow. They borrow
Mm-hmm.
money for investment.
And that makes it a better borrower? Yeah, you're right. If a company has a better growth prospects, the company has a good future, right? So if I'm a bank manager and if I have a company with lots of capital but no growth potentials, then it will put me off. But if you're a company which is not having much capital, but I see that your growth prospects are quite nice. You're a good borrower. Yes.
History of short-term and long-term loan.
Mhm.
Non-current liability they have.
Mhm. Can I say that your credit history,
Yes. That,
uh, if in the past you have committed some default, you haven't made your payments, and when the company asks you for the credit check, if you're a bank, if you're a company and you come to me, I will say that, hey, could I check your credit record? You know what? Everything is fine, but there have been 3 instances when you didn't pay your debt, or you committed some default or something like that. Sorry, I can't, because you can repeat the same thing. Okay, so the credit check, the credit history is a good measure. Yeah. In many cases, when you get a job, like when I was working a teacher in the schools in Scotland, every time, because I would have the short-term contract, 6 months, 1 year, every time my contract was revised, they will ask me to get an enhanced character disclosure check, which checks that have you committed any crime, all kind of disclosure, because you are going to see the very vulnerable age. So every time they revise your contract, they not only ask you for a disclosure, but an enhanced disclosure, because you're dealing with the kids. You get my point? So there's an extra disclosure. In many times, if you want to deal with a company, let's say somebody says that, hey, I know you are a very good producer of goods, we want to buy from you. And I know that you are granting the 90 days credit period to your customers. We want to buy from you, but will you also give us 90 days? You say, wait a sec. I will give it to you, but can you bring your credit history? If your credit history is clean, believe me, I would give you same facility which I give to my other customers. Or if you are shirking to bring, I would be suspicious. Or if you bring, there are a couple of examples that you have done not so well. Sorry, I can only give you 60 days or 40 days, or maybe I don't give you any. The same thing applies for the bank. So the banks can also ask you for these checks, especially when you're living in one country and borrowing from another country. So in that case, the banks, or if you want to open a new bank account, then they can even ask you that, can you bring the credit check from your existing bank so that we can see, or they can even phone the other bank next door. Next, what? What next? Yeah. What comes next? Any other parameter? Yes, Nico. Mm-hmm. Mm-hmm. But isn't that comes in the category of credit history? Yeah. But see what? I see your point. Oh, That was very
I mean,
dangerous
like,
hissing sound. Mhm.
transport, no already paid.
Very good. I got your point. Seniority of debt. If I'm your lender, if I lend you money, I would always check, am I senior lender or a junior lender? The senior lender is that if you have borrowed from me first time, but let's say you already have borrowed from 3 different banks, and then you come to me for another fresh dose of loan, then I must be aware that if your company become bankrupt, even though you pay money to the lenders before you pay to shareholders, but even in the category of lenders, I would be 4th in the queue. Are you with me? I'm not senior lender. There are 3 more banks who would be standing in front of me. And maybe all the assets are grabbed by those 3 banks and nothing is left for me. I'm at risk. I don't want to be a junior lender. I would say no. Or there's one thing I can do. I can ask you to pay more interest rate as a cost or a premium or a compensation for extra risk I'm taking. So I would say that, okay, from bank A, you pay 2%, bank B, you pay 2.2%, bank C, you pay 2.3%. Well, they should also charge more because A is the least risky in the queue because A is the first bank, B, second in the queue, risk premium, C, even more risk premium. And if I'm the 4th banker, I should charge even higher risk premium. Or I don't accept your loan. If I accept it, then I should charge more risk premium because there's a more risk falling on me. Because if you have a mortgage of a building, all right, it could be possible that when the loan is defaulted, nothing I get because all the property, all the mortgage is distributed by the first 3 lenders in the queue, and I return empty-handed. No, this is unacceptable. After all, I have to be accountable to my shareholders also. I also have my share. They will come and catch hold of me. So the seniority or juniority matter. Yes, please, you have a point.
What about the purpose of borrowing money?
Yes, the purpose of borrowing money. If you buy loan for consumer purpose, yeah, or if you buy loan for the investment purpose, it differs. Yeah, and if you buy loan for the business purpose, then it comes to this point, which has more growth prospects. But yes, if you buy a loan for consumption purpose, then bank is a little bit shy. You get my point? Because that is not going to yield any. When I give you loan, I also want to check your earning capacity. Is my loan affecting your earning capacity? Well, in case of consumer loans, it doesn't. Right? If you take a mortgage from me, you buy a house. In fact, after buying house and after taking loan from me, your expenses will rise because you have to pay Vastike, the monthly charge you pay to the cleaning company, and then there are some utility and so on and so forth, right? But if you want to have the same building, but you want to convert it to a guest house or a restaurant for the commercial purpose, yes, there is a income stream attached to it. So my risk premium is lesser. So yes, you're right. Even though it connects with this, but I would rather write it as a separate point, the purpose of debt. Very good point. Yes. Reputation of the company is very high. If not high, but important. How do I assume that the reputation is high? If a company has a high reputation, the company pay less risk premium. Can somebody tell me which company, though in the private sector, do not pay any risk premium? Remember, your interest you pay have two things. I think it's a very important point you raised. Your total, I call it gross interest, yeah? gross interest rate is equal to net interest rate, which is only because of the use of money, yeah, plus risk premium. As long as the company has some riskiness, risk attached, this would always be positive. Which company who I lend, I don't see this thing. I call it zero. And I only give you loan for this purpose only. Of course, this I have to charge because after all, I'm a commercial entity. Which company I charge only net interest rate, zero risk premium. And that you can say that company could be government company. Yes, it can be. But my example says no. Which private company? You know any company or any ideas? Which are those companies, private companies, who I charge zero risk premium? Any ideas? Those companies who S&P rate as AAA, AAA companies. Have you heard about companies that the rating of the company is AAA?
Yeah.
No, haven't you? You should. There is a rating of the company. And if a company, normally the three rating agencies, Moody's rating agency, S&P, then Fitch. I think S&P is a still very popular rating agency, and they give AAA to the company which has literally no risk. Yes, Felix, you have a point?
Yeah, but it's not that they know no risk. They always have a bit of risk.
Well, in that case, even state has the risk. In theory, even the government can collapse.
Even the state.
Yeah, yeah.
Some states don't even have AAA.
Of course not. Do you want to see the list? I can show you hundreds of countries which are. Yesterday, I was in another lecture. I was comparing that if you want to, when a Finnish company goes to Australia, Austria, and Bahamas, the two kind of risks you face. One is the company, your partner risk, and secondly, country risk. And we found that Australia is AAA, AAA. Austria is not AAA. Austria is AA plus. So basically, I can say that Austria is riskier than Australia. And Bahamas rating was something B, which I would say, hey, if I were you, I will never go. But the point is that the same way the countries, the companies have the rating as well. AAA companies are reckoned as the safest companies. Of course, based on our assumptions.
But they still have the risk.
Of course they have.
So never purely the net
At a given point of time, because when you say there is still a risk, if there's a risk that will emerge in the future, but at a given point of time, there's no risk. And remember, this rate is this rate. Wait a second. This rate is published on daily basis. This is published on everyday basis. All right. So on a given day, I can say that hey, today there's no risk. You know, maybe tomorrow, but then it will change. Then it will change the rating of the company. It will not be AAA. It's not eternal that you will always be, if one's a AAA, always be AAA. No, not like this. The rating can change. Yes.
But it's not no risk, just risk test companies think that they just they analyze the whole company. I don't think it's on a daily basis.
It's on daily basis. Yeah. LIBOR, for example, yeah.
But the point is,
Or Euribor is calculated on everyday basis.
These are assessments for loans and investors. So yes, of course, even AAA have risk.
They have risk for sure.
You use these very famous companies like Standard & Poor's that their entire name depends on good assessment. They will analyze the financial status of the company, and you can use that as a investing.
As a benchmark, yeah.
Yes. Yeah, as a benchmark. So yes, there is risk.
There is risk.
You,
Yeah.
you can definitely trust a company,
Yeah.
AAA,
Yeah.
more than a company that is triple C.
I would slightly rephrase it. if these rating agencies publish their daily rate of interest, not daily, but after a month or after a year or after 6 months, there'll be no AAA company.
But companies, they pay to be rated.
Well,
they hire the rating company.
Yes, now we can go in the another side of the story, but let's talk the normal situation, the normal business situation, that the rating agencies, they give you some rating. Yeah, of course there's always some hanky-panky. Oh, I'm using this word after 6 months. Last time I used it was in last semester in economics. Oh yeah, okay, so hanky-panky. Of course they can do it. But in the normal course of business, we assume that things are fair and square. It's a big assumption, but let's assume. Let's keep our problems less. Yeah. So the AAA companies, bye-bye and have a nice holidays. So the AAA company is the one which pays 0 risk premium. But if you are A plus, for example, yes, sir.
But they still do. A bank, I would argue that a bank never gives out a loan without any risk.
They do give. They do give to AAA companies.
Do they?
They give. Yeah. I'll tell you a system. In London, what they do. In London, there is a British Bankers Association, BBA. And I'm telling the fact because I have been dealing with them when I was working for the hedge fund. This data is maintained by Thomson Reuters. Okay. British Banker Association have a list of top banks in the world. And this list also keeps changing depending upon how good bank you are. You know, it keeps changing. Let's say they have shortlisted 15 banks based in London or having operations in London. And then this BBA, British Bankers Association, that tells the bankers every day, hey, how much rate of interest you give today to a company which is AAA. And then they say, all right, Bank of Scotland say, I would give 1.1%. HSBC says, I would give 0.9%. And by doing so, they get the quotes from 15 biggest banks in the world by 10:30 every day in the morning, Monday to Friday. At 10:30, when the bank BBA have got these quotes from all the banks, then they find the median rate of interest. You know the median? The one which comes exactly in the middle. This data is sent, that middle rate is sent to Thomson Reuters around 11 o'clock by BBA. That is the rate of interest which is charged from the safest company in the world. It's called LIBOR.
But what says those 15 banks don't have the risk premium in the interest rate?
Well, I'll tell you something. They make changes here, for example, in the net interest rate. You see, sometimes the macroeconomic situation changes, so the net interest rate can change, but that's not a fault of the company. Company is still the safest. You get my point?
Yes, but what says that the interest rate that they give doesn't have the risk premium in it? Or?
No. The net interest rate keeps changing. For example, if in the country, let's in the country, the Bank of England says, you know what? We are cutting down the supply of pounds in the market. Demand for money shrinks. Right? Supply of money shrinks, the interest rate goes maybe by second decimal point up. That is the net interest rate goes up, not the risk premium. The company's fundamentals, foundations are everything same. And don't forget that these are for the short-term borrowing. And this rate of interest is published. If something horrible happens on that day, this may affect next day. And it could be possible that some companies next day no longer remain in the AAA list. Enron was a AAA company, by the way. It disappeared. So they are publishing this rate of interest on everyday basis and for the short-term borrowing, very short-term borrowing. And this is revisable. Otherwise, they will not publish it every day. Yeah. I know you don't agree. Yeah. Yeah. But we see from the operational sense, of course, no company, nobody in philosophical terms, nothing in the world in life is risk-free.
No, I also get your point. Is there like actually any proof that those banks don't give a risk-free?
Go to the BBS website. We can go to the
Also, if it takes too much time of the lecture, we can discuss it later.
I can check for you afterwards. I have an article I would share with you in Optima discussion forum that how this daily interest rates are fixed through LIBOR. And then in Europe, we have the Euribor. So that's equivalent of LIBOR in Europe here. Okay. The company reputation have an impact on making you a good borrower or a bad borrower. Yes, you have a point. Did you raise hand? No? Some? Anybody else have a point to make? Any idea from this side, this quarter? No? What about the steady flow of income? If your cash flows are erratic, certain months the cash is zip, other months down, and on the as against the company's cash flow is fairly consistent. It's not very skyrocketing and going down so often, but the company has a very steady cash flow. As a banker, should I be happy or should I feel not so good about it? So consistency of cash flows, if your revenue cash flows are consistent, it's a good point. So if I can say so, if the company's consistency of cash flow, rather cash inflows, because cash can flow out also. So cash inflows. Igor, you have a point? You raised hand, I guess.
Yeah.
Or you change your mind, okay. Anything else can make you a good borrower or a bad borrower? How about low operating cost? If you're a company with low operational cost, your daily cost, for example, your cash cycle is very small, your inventory days are small, you don't have to stock too much, you have for the same size of the building, you have not recruited many people. Basically, there's not 100 people working here, so no 100 salaries, only 2 or 3 people taking care of everything. Your rent is less, or whatever piece of land you have, you are income generating, not expense spending situation. Whenever this point comes, the only company or the first company which comes to my head is Coas. Coas. This Central Finland housing company. Student housing company, not housing, but the student housing company. The company comes in low operating This company very well fits into 0.7 and 8. The company, Quas, has very consistent cash flows. Normally, every business is on cash and you don't default. Normally, people pay. So it could be delays, but there's no major problem. Cash flows are fairly substantial and very consistent. And on top of that, their operational costs are very less. How many people manage Quas operations? Many of you live in Quas. I lived for many years when I was a student. I came as a PhD researcher. I would say that if Quas was not a housing society, but some bank or some other factory type of situation, there would be more people working there. So then imagine a building, more people working there. So Quas is paying them. But now people not working there, Quas is not paying them. Rather, tenants are living there and Quas is getting money from them. So instead of expense spending situation, you are generating income from different floors, block, 2 parts, 4 floors, 4 houses, occupied, cash flows, money coming in. Janitors, 2, 3, 4, they're taking care of almost everything on daily basis, all the places. Not many people in their main office in Keskusta. So I would say that Quas is a building, is a company which fulfills 0.7 and 8 very well. Isn't it? Very low operating cost, considering the size, considering that it's a very tangible asset-based company, property-based company. If you see the number of wages, the wage bill it pays, it must not be too much. Because mostly people who live, the human beings who live there, they pay money to Quas, not Quas pays to them in the form of salaries. So the operational cost is pretty much in control. Anything else which makes you a good borrower or a bad borrower? How about company's history, legacy? You can call it reputation also. Normally, companies which have a history, have a legacy, they are good borrowers. But you can also connect it with that because they are surviving, hence they're more reputed company. Otherwise, why would they survive? So, for example, startups are not falling in the category because they have no history, in fact. Or if they have a history, it's a very initial history full of, ups and downs in the initial stage. So they don't have real consistent performance. Well, yeah, so it's like a matrix. You take plus, minus, this is good, but this is not good. So you make an overall assessment. It's like a tick box. So if a good thing, growth prospects, yes. Legacy, no. I would be very interested to see if a company applies for loan. I would say, could you please submit your business plan? And could you please in your business plan also write down your organizational structure? I want to see who are the people running the show. If I find some familiar names who have a history, not only the company's history, but their own history, they are great entrepreneurs. Their job is, there are some habitual entrepreneurs. What they do, they start up a company, build it, sell it, and again start from scratch. So they are compulsive entrepreneurs. So they always in an entrepreneurial cycle. They never stick with the company for a long time. They just come, start, when it's on its own feet, sell, restart. So not only the history of the company per se, but I would like to see the history of people. Do they have a track record in the past? That's very important. So then it will give me some confidence that, hey, it's a startup company, but you know what? People who are running the show, I can vouch on them. I trust them. So the kind of people, so I would say the leadership thing. So if the leadership, is good, you can be a good borrower, right? Anything else which you think? Yes,
Can I
sir.
ask a question? Do you think banks go to the, I don't know, do they get bothered and they're going to make a thorough background check?
I would say yes, they do. They do. Considering this after 2007 crisis, banks are under severe pressure to check the credibility of their prospective borrowers. They do it. Yeah. It was not in the past. But now the banks are working in a very stringent environment where they have to be filling so many disclosures and stuff so that they really have to do it. If a bank is not doing it, it can invite the problem of the regulator. Okay. And in this case, the private and the government banks are same. They all are very stringent. Yeah. Anything else? If nothing else, then we can take a break now. And well, you can have a very good break. I would say come back at 3:25